Welcome to these first sessions of Private Debt Funds Insights. In this new concept, we will be interviewing players from the private debt funds industries in no more than 3 questions. Today, I'm with Michael Pote from Permira Credits. So Michael, today you are a senior director at Permira Credits, and Permira is one of the key specialists of European lending. I believe that your company has provided over 18 billion in debt capital, right, to over 300 European companies. So from your perspective, Michael, what makes private credits an attractive asset class in the current economic environment?
We see the current environment as being increasingly favourable for private credit. We are in a low growth, high interest rate and high inflation environment, and this is generating some economic uncertainty. And as a result, the liquidity in the credit markets is at lows not seen since the global financial crisis. The high yield markets and the bank loan markets are undersupplied. And in this environment, direct lending has been increasing its market share, particularly from the broadly syndicated loan market. Over the last 12 to 18 months, direct lending has been financing an increasing majority of leveraged buyouts in Europe. And in Q1 this year, for example, direct lending financed nearly 90% of European leveraged buyouts. The opportunities we are seeing are generating higher yields with better quality borrowers and improving lender protections. The higher yield is driven by the increase in base rates, which, as we are investing in floating rate debt predominantly, we benefit from, and increased margins. And this means that a senior secured loan, which would have generated a yield of 7 to 8% at the start of 2022, would now yield in excess of 11%. And what's important here is that in the opportunities that we are executing, we do not feel we are taking significantly more risk. In fact, leverage levels tend to be stable or lower, and we are seeing higher equity cushions, and this mitigates our investment risk.
And how is Permira approaching this volatile environment?
Permira Credit is one of the few leading European direct lenders with a consistent track record across multiple economic cycles. And that experience informs our approach today. We are investing highly selectively, favouring less cyclical sectors such as technology, healthcare and business services, and in companies with strong cash flows, predictable revenues and high quality equity sponsors. And we feel those characteristics offer the best source of downside protection at entry. Over the life of the investment, our dedicated portfolio monitoring group monitors the performance of each company. And this allows early intervention, if necessary, working together with the sponsors and the management teams. Sometimes things don't go to plan. And in that situation, we can pivot very quickly from being a lender to the business, focusing on downside protection, to being an owner of a business, focusing on maximizing value. Our specialist restructuring team will work to maximize recoveries for our investors, and in sometimes this might even generate an equity-like return. In all these aspects of the investment life cycle, a huge differentiator for Permira Credit is our integration with the broader Permira platform. This gives us access to the huge investment, origination, and operational expertise of our private equity colleagues, and this is a huge advantage for us.
So, we're already reaching our last questions. Michael, what would be your view, your vision of the future for this asset class?
I would highlight 3 micro trends, if you like, within the sector. First, an ever-increasing focus on ESG. Our latest direct lending fund, which is our 5th vintage, closed in May at 4.2 billion euros, and that was an Article 8 fund. We think Article 8 will be the minimum standard expected by investors going forward. The Permira Group has built a team of 6 ESG specialists with the mandate to drive ESG initiatives across the business and our portfolio to support this. We expect to see increasingly differentiated performance in our sector over time. We think lenders with the strongest origination platforms and well-resourced portfolio monitoring and restructuring teams will show the most consistent performance over time. And third, we see a multi-year opportunity for opportunistic credit. This is partly due to the lack of liquidity in the capital markets, which I mentioned earlier, but also reflects the huge volume of European debt approaching maturity in the coming years. The challenge some companies will face is refinancing this debt in a high interest rate environment while their cash flows are still negatively impacted by cost inflation. And we feel this will throw up some attractive opportunities for funds with flexible mandates. On a broader level, we think the asset class is here to stay. The high yield markets may reopen, bank lending may come back, but the value of direct lending from a sponsor's perspective is now well understood and proven. And here I'm referring to the certainty of execution, the flexibility of structure, including the provision of, for example, delayed drawdown facilities, and the simplicity of communications and decision making. And we think these characteristics mean that direct lending is here to stay and will be an important part of financing solutions for sponsors for the foreseeable future.
All right. Thank you, Michael.
Thank you.
And goodbye.